What's up guys, welcome back to the channel. I'm Mike.
And I'm Brit.
And in this video we're going to be talking about 3 obstacles you'll need to avoid when it comes to investing in the stock market. So about a year ago, Brit and I were brand new investors. We were consumer debt free, we had just purchased a house, and we felt like the next logical step for us to take financially would be just investing in the market to help grow our wealth and hopefully allow us to become financially free in 10, 20, 30 years in the future.
That being said, we had very little understanding about what we were doing back then. And even though we had a solid grasp on our money when it came to our personal finances, there were still obstacles we had when it came to investing. And that was because it was something brand new and something we've never done before.
Yeah, it was a totally different way of using our money than we had been used to up to that point in our lives. So what we did was we started off slowly with $1,000, and over the last year or so, we've gradually built up our investment portfolio to around $22,000. During that time, we've learned a lot, and we've made a number of mistakes. And our hope is, by the time you guys finish watching this video, you will have learned from our mistakes and we'll hopefully have gained some knowledge and some information to help you guys from making the same mistakes we have, and maybe even hopefully allow you to build your wealth even faster than what we have so far.
So the first obstacle we ran into when it came to investing was the fear of losing money. So this could be easy for some to overcome, but difficult for others.
Yeah, in my case, this was a very difficult thing for me to get past. If you guys have been following our channel and have seen like the first bulk of videos that Brit and I made when we first started YouTube, you will know that we went through Dave Ramsey's Financial Peace University, took 3 years of paying off debt, and we're just living on beans and rice and beans, living very, very frugally, scorched earth for the first 3 years of our marriage. And then we lived like that for another 4 or 5 or 6 months after to save up an emergency fund. And then we went to Hawaii and lost a bunch of money. And we continued to live like that for another year while we kind of recouped our finances. After we were finally back on our feet financially, we continued to live like that to save up the money for this house.
Yeah.
And then the market tanked, and then I lost a good portion of my income. So we continued to live on scorched earth after that. So it's like, ever since we've been married, we've had to live like this, and it's like hardwired into my brain now to live very, very frugally, don't lose money, keep all of your savings in a very safe place, and that's it. Brit and I were used to just having this big pile of cash in our savings account. It wouldn't really go up in value all that much, but it definitely wouldn't go down. And so we became, I guess, very psychologically reassured by the security and the safety of having a big pile of money in our savings account. And this is like on top of our emergency fund as well. And the thought of putting money into the stock market where the value of the money that we put in there initially could go down scared like the life out of me. It's like we're doing something wrong. Like we're not supposed to be losing money. We're not supposed to be taking risks here. We're supposed to be piling up this big safety net in case something bad happens, which there's been many things that have been bad to happen to us financially since we've been married.
So we basically learned that our fear of losing money was preventing us from making even more money in the future.
Yeah, and what happened was we had not a super huge chunk of money that we could have invested, but a decent size of money we could have invested at the bottom of the market last year. And we ended up not doing that intentionally. We put $1,000 in instead of a lot more money. And this ended up costing us about $20,000 in potential profits that we could have made. And that was at our very limited knowledge level back then when it came to investing. If we had known then what we know now, we probably could have made $100,000.
So how do we get around this? And how do we get over the fear of losing money? Something that helped us was a quote by Jim Rohn: "We must all suffer one of two things, the pain of discipline or the pain of regret." And the pain of regret is something we're definitely feeling right now.
So what we'd recommend is just face your fears. Just start off slow, especially if you're fearful of, the value of your portfolio fluctuating up and down, or especially going down a little bit. Put just a little bit of money in the market, an amount of money that you're not afraid of having, go down a little bit or watching fluctuate a little bit. Buy 1 or 2 stocks or ETFs, a good broad market ETF or index fund, something like VOO or VTI or VFINX or FXAIX. And what these are is just S&P 500 index or broad market index, total stock market index, or the ETF equivalents. And if you're not sure what those are, don't worry. They're a collection of individual stocks. They're supposed to be a representation of the index they track. So for example, VOO tracks the S&P 500, so you're going to see a collection of stocks within VOO that kind of represent that entire index. These are slow moving, they're very low volatility, and they performed very well over the last 10 years.
And these are some of the biggest and most reliable funds on the planet right now. And what we wouldn't recommend doing at this point is investing in anything risky.
Like GME or Dogecoin or things like that. Like the last thing you want to have happen right now is to put your money in something that's going to go up or down 20% every day. That's going to really get to you psychologically, and it's going to put you more at risk of making poor decisions based on emotions that could actually end up losing you all your money, which would not be good.
So starting off slowly is going to allow you to get your feet wet and basically grow your knowledge bit by bit.
And chances are what's going to happen to you is exactly what happened to us. You're going to realize, you're like, hey, this isn't so bad. What was I so scared of? And the more you learn, the more experienced you get, the more comfortable you'll feel, and the more likely you are to make lots and lots of money. Something very important to realize: whatever losses you see in your portfolio right now, assuming you're invested in solid companies or index funds or whatever, those are just temporary. If you're investing in good, solid companies for the long term, chances are, and the odds are exponentially stacked in your favor, that over the long term, 10, 15, 20 years, you're going to make triple, quadruple, quintuple, or septuple your money, and who cares what the market does over the next few months. The second obstacle that we've run into ourselves, or at least me, that we would recommend avoiding and getting over is trying to time your entry points perfectly. And if you're not sure what an entry point is, it's basically like when you first buy into a position. Let's say you want to buy a stock of Apple. Whenever you buy into it, that's your entry point. I have found myself trying to make an entry point in certain funds or stocks at the best and lowest possible time during the day or the week or the month, or etc. And this has led to me just kind of staring at my computer screen, watching the chart of the stock go up and down, and me looking at technical indicators and technical analysis and like studying the market and what's happening in the news. I get stuck in like this analysis paralysis, if you've ever heard of that phrase. Sometimes that has meant that I missed out on a big price jump during the day or the week. So how do we get around this? What's the solution to this? And how can you overcome this more quickly than we did? Something I didn't realize is that compared to 10 years from now, right? Especially if you're investing long term, 10, 15, 20, 30 years, whatever the price is right now, like there is a 99.999% chance this is the best time to buy. Yeah. Whatever the price is today, or a week from now, or 2 weeks from now, it is the best time to buy when you're thinking long term. Another thing is there's been a lot of studies about trying to time the market, and just about everyone that I've read concludes that it's just nearly impossible, if not impossible, to do that. That being said, there are, in my opinion, some pretty good technical indicators that would potentially kind of give you an idea of a direction that the market could possibly go, depending on certain circumstances, but really nobody knows for sure. Yeah. So if you're investing for the long term, who cares what the price is today? Like, who cares? Let's say I'm trying to buy a stock that's $100 right now, and I'm watching this chart like a hawk, waiting for it to go to 99 so I can get it 1% cheaper. When 10 years from now it's going to be $400 or $500. Like, what difference is a dollar going to make today when the stock price is $400 or $500 in the future? The only asterisk I would say here, if there's something very big that's just happening, like, for example, the government saying they're going to shut down the economy for a month or two, like what happened recently, maybe not invest right now. We're talking about events, 1 in a 100-year events, things like that. So more than likely it's not going to be the case whenever you're looking to invest. Another thing is, if there's a company or a fund that you're looking at that has gone up and up and up and up every single day for a week or a prolonged period of time, I would maybe recommend doing some research into why that company or fund is going up so much so quickly. Because just from my limited experience, what I've noticed is that things that go up very, very quickly in a very short time period seem to fall very quickly shortly after that as well. Not always though, again, can't time the market, but it's just something to look into.
So the third and final obstacle we faced was wanting to be a professional investor way too quickly and not doing enough research on what we were investing in. So for example, seeing the ETFs you've invested in and other stocks going up 10% and saying, oh, I got this, and starting to invest in other companies you have no clue about.
So that initial $1,000 that we mentioned at the beginning of the video, the seed money that we first invested into the market, that was invested into a lot of companies and funds that if I'm being honest, we didn't research nearly as much as we should have. Thankfully, everything we bought into was pretty solid and has given us a solid return so far. Some of those companies we bought into initially are cyclical, meaning they have periods of the year they go up and then periods of the year they go down. We definitely didn't know this when we first bought into them. And had we bought in at the kind of beginning of the downward cycle, we would have seen all of our money going into the toilet. And more than likely we would have made an emotional decision. We would have been like, hey, oh my gosh, like we're losing a bunch of money. Let's pull all of our money out before we lose all of it. We would have sold at a substantial loss instead of understanding that that's just a cycle.
And then it was going to go right back up.
We would have lost a substantial amount of money instead of just kind of waiting for the market to do its thing and then buying at the bottom to make a bunch more money on the way back up.
So another mistake we made was investing in a lot of individual companies when we were first starting out trying to invest. They were a lot more risky than just investing in ETFs?
ETFs, index funds, you got a bunch of companies held in there all together. You got somebody managing everything and making sure, the risk is well spread out. You have people managing these funds that know a lot about what they're doing, whereas we were just beginning, we had no idea almost what we were doing. It worked out just because we were buying at the bottom of the market, but if circumstances were different, there would have been a much larger chance of something happening and us, seeing the value of our portfolio going down and wanting to sell out and losing money.
So how do we get past this urge to move too quickly, but still being able to move at a pace to become a good investor?
So we would say if you do get to the place where you want to start looking into investing into individual companies or maybe like funds and ETFs outside of the general S&P 500 or broad market index, that sort of thing, our advice would just be to learn how to research what you want to invest in.
So some things we've learned to look into when researching companies are: how's their management team? Who are their competitors? Do people like their products? Are they profitable? Do they have any debt? Is their revenue increasing or decreasing year over year?
Do they have any plans for the future? Any future products that they're trying to expand out into? What's their PE ratio and PS ratios? And how do those compare to the market? And if you're unfamiliar with PE and PS ratios, it's just basically those are metrics of how expensive a company is to buy. What economic variables could have an impact on this company's stock price? So for example, if you're buying a company in the tech sector, you may want to pay attention to what 10-year treasury yields are doing, because just recently the increase in the treasury yields caused a decrease in the tech sector, and people were freaking out over it. I think it's since recovered a little bit, but that's something to keep in mind. Another example in the real estate area, if you're investing into REITs, real estate investment trusts, you may want to pay attention to what the Fed's doing with interest rates, because interest rates are going to have an impact on mortgage-backed securities, and then mortgage-backed securities are going to have an impact on the real estate market, and then that's going to have an impact on REITs that you're directly invested in if you want to invest in those. So it's a good idea to kind of like get a little bit of an education in like macroeconomics and microeconomics and these sort of things. So the more educated and researched you are about what you're buying, the less surprised you'll be if some big moves happen, and the more prepared you'll be to take advantage of those moves, and the more likely you will be to make decisions that are based on logic rather than emotion, which should in turn help you make lots of money in the future. So with that being said, guys, those were Brittany's and my 3 obstacles that you need to avoid, things that we have run into that have caused us to make some mistakes when investing in the stock market. We've tried to think of things that would be more applicable to like a general investing audience rather than things that were super specific to us.
Yeah.
We hope this video was helpful. We hope it provided some value to you guys and maybe helped give you guys some things to think about. If it was helpful, please give it a huge thumbs up. It helps out tremendously with YouTube.
And if you had to overcome any obstacles or made any mistakes, please leave them down in the comments below. We'd like to hear your thoughts.
Definitely.
And you can follow us on Instagram at @ItsBangABrit. We post there every now and then.
And with that being said, thanks for watching, guys. We'll see you next time.
Bye.